people tend to have recency bias. So there's this concern with retailer earnings, for example, this week that consumption could slow decidedly. We could have a recession. And what I'm trying to remind the viewers of is that this slow consumer spending trend that we have after the global financial crisis was because debt was so high for the household sector and household balance sheets were so impaired. This go around, the opposite is true. Debt is at the lowest levels it's been since the late 90s. Financial obligations ratios, the percent of disposable income that goes to interest payments, is at historic lows, and household balance sheets are quite strong. So if you think then what's likely to be the trend to consumer spending in the 2020s, and you further consider demographics, and I know people are fond of saying, well, we have aging populations and aging population in the US, which means consumption is going to slow. It's actually not so simple as all that. In the 2010s, you had baby boomers preparing for retirement. That's a very big demographic in the US. There's 77 million of them. This go around, we have Gen Zers preparing for retirement. There's only 63 million of them. And millennials, which is our biggest age cohort, 83 million of those, are actually in peak consumption years and forming households. So we have a very different demographic backdrop for consumption that would imply trend might even be stronger than 3%. So while I say growth is slowing, but not going to be slow, that's integral to my view. Once all this noise switching from service spending, good spending to service spending settles out and we figure out where true growth is going to be, I think it's going to be stronger than last cycle, perhaps quite a bit stronger than last cycle. So inflation will be higher, nominal growth will be higher, but real growth will be higher as well.
Interesting. And I want our viewers to understand, I think that's one of the more bullish views out there these days. Would you agree?
I do. I think that there's a lot of misunderstandings around how all these business cycles work and how demographics work. I think people just extrapolate straight out. And nominal growth matters a lot. So the period that I've drawn the analog to that I think is most interesting and most informative is what happened in the 1960s. In so many ways, the 50s were like the 2010s. We were coming off the Great Depression. We had very tight bank regulatory policy. We had very uneven growth, very weak capital investment. All those things were similar to the 2010s. But in the 60s, we started to have much stronger nominal growth. Inflation started to grow, and go up decidedly. It was a reflationary period, but that actually meant stronger earnings growth, stronger nominal GDP, and a period that was not so good for the bond market, but pretty good for the stock market for a good deal of time until ultimately we got to the 70s. Now, some people have skipped straight to the 70s and think that's where we are. I do not. I think that we are going to be in a higher inflation environment, but not a rapid inflation environment once all of these cross currents start to settle down.
Interesting. Yeah, everyone's jumped to the 70s. Some have moved to the 90s, but I haven't heard the 60s, so that's interesting. One piece of information I wanted you to address, though, the earnings and the stock reaction to Walmart and Target the other week were something we've not seen. Well, I don't think the stock price performance for one of them was that bad since 1987. I think it was Walmart. How do you explain that as it relates to the consumer? Just we only got about a minute in this segment.
Sure. The most important number that we've gotten in the last month was the March imports number. And this seems like a little bit of an obscure number, but March imports increased 26.4% from February. That's the single biggest increase in imports that I can find going back to the mid-60s. And what that represents is supply chains clearing. So we now know where all those imports went. They went onto Walmart and Target shelves. That, of course, means they have excess inventories. They're going to have to cut price. We've seen prices start to fall sharply. Goods prices start to fall sharply. Even this morning's core PCED number reflected that. So this was actually more of a price effect than a demand effect. Another way of saying it is the supply curve shifted more than the demand curve did. It caused a big margin hit for those stocks, but I think the macro interpretation of that was an overreaction.
Okay, we'll leave it there. We'll pick it up on the other side of the break.